Good afternoon, ladies and gentlemen. Very warm welcome to the weekly market review for the week of the 17th of April. So I am Benjamin Goh, the Head of Research and Investor Education here at SIAS. As usual, we have our Senior Technical Analyst, Sunny So, with us today. We're going to be talking about the fundamentals as well as the chart in this segment. The disclaimer is that SIAS is a registered charity. We are not licensed by SIAS, so whatever that we talk about today, especially for specific stocks or companies, cannot be misconstrued as a recommendation. So do see a licensed financial professional before taking any kind of action in the capital markets. So just to let you know, FYI, the upcoming SIAS is going to be on Wednesday, 7 p.m. Actually, I should be going through the slides later on, I think. I got my slides backwards. And this is the QR code to sign up as a member. Okay, now back to our content. I'm going to be talking about inflation as well as stagflation risks. Okay, so we got a good news, bad news problem, right? So the good news is that the easy part of inflation it's basically over. That is the headline inflation numbers globally speaking in most countries is coming down. All right, so headline global inflation is forecasted to hit 5.9% at the end of this year, at the end of fourth quarter 2023, and 1 year later at 4% in the end of 2024. So this is far and away a huge improvement compared to what we are seeing in the emerging markets as well as the advanced economies back in the middle of 2022, where for some countries the headline inflation was double digit. Now, obviously, Singapore's inflation didn't hit that high simply because of the series of tightening affects Singapore dollar trading bans that MAS has instituted. And of course, the last one or the last meeting by MAS, they had actually kept the ban unchanged. All right. Now, the emerging market inflation, as you can see in the blue line, excluding China, has been on the downtrend, but obviously coming off from double-digit highs in 2022, it's going to take far longer to hit, below 5%, below 4%. All right, so that's for emerging markets. Obviously, emerging markets have been buffeted quite, quite badly because of changes in energy prices, as well as agricultural prices, because of the war in Ukraine, so on and so forth. So they have an additional level of risk, and that's always the case for emerging markets. China itself is wrestling with a issue of lower growth rather than inflated inflation. That said, Bloomberg Research does forecast a spike, or rather a temporary spike in CPI numbers for China heading into 2024, simply because of the dismantlement of the zero COVID policy in China. We are already seeing slightly higher outbound tourist outflows from China, as well as higher demand since people are going out to shop as well as eat more often. Now, that's the headline inflation. Now, the hard part is basically the core inflation, right? So there are two parts of core inflation. We have got core inflation itself and then super core. So core inflation is defined as headline inflation minus energy as well as food prices, simply because those are quite volatile. Super core inflation is headline inflation minus energy and food prices as well as housing prices, all right? So we'll be talking about all these in turn. Now, if you look at the first paragraph here, US headline CPI in March was 5%. This is on year-on-year basis. Quite a drastic drop from 1 month ago. February's number was 6.0%. The consensus estimate was 5.1%. So as you can see, US CPI in March fared far better compared to the month before, as well as the consensus estimate. So that is the good news. All right. Now, the other shoe is basically the core and super core. Now, for US core inflation, the March actual of 5.6% year-on-year versus February's 5.5%. So as you can see, this was actually a deterioration of core inflation by 0.1% versus the prior month. Now, if we were to unpack this, we have got core goods inflation. March was 1.5% year-on-year. This is the fastest reading since December 2002. On the other hand, core services inflation for March was 7.1%. As you can see, that's rather high, but it is the smallest increase since December 2002. So this is, again, good news is bad news. So for goods, it looks as though the issues with supply chain, global demand, so on and so forth, is driving up prices. For services, still quite elevated. It's coming off a little bit, but it's still relatively high. The good thing is that it is increasing at the slowest rate since the end of last year. Yeah, I think I got the date wrong. It's supposed to be 2022, right? Not 2002, but anyway. Okay, the other thing is that the picture that is being conjured right now is that the problem with the core services inflation comes back to wage inflation, right? So because people are expensive, and what happened in the last 2 years was that there was a huge jump in the hourly wages, average hourly wages of people working in the US. That is continuing to feed into the CPI numbers. So as we have spoken about previously, wage inflation is going to be sticky, it's going to be stubborn, and that is the hard part that we're talking about here. Supercore inflation for March is 5.8%. Again, rather high on a year-on-year basis. So both the core and supercore seems to be a bit sticky, a bit stubborn, not coming off as fast as headline CPI numbers. This is the hard part because it generally takes a lot more work to kind of break down the numbers. And if you think about it, core and supercore inflation, it's really because of domestic economic dynamics in the US rather than globally traded prices for agriculture or oil, so on and so forth. So wage inflation is generally keeping core and supercore inflation pretty stubborn, pretty high, pretty sticky. Now, looking at a chart, you have headline inflation, which is basically the white color line, which is coming off quite drastically, as you can see, minus 1% change between March and Feb. But the supercore and core are coming down a little bit, or rather much slower in terms, and in the case of the core inflation, it's actually going up slightly. So as you can see, right, the Fed will need to probably keep the interest rate rather high for a slightly longer time, basically to engineer a cooling down of the labor market in the US. The labor market is still rather tight, so it's still hovering around historically low unemployment rate. The participation rate is not improving drastically, and in some industries it's still quite tight. Now, that said, looking at the last non-farm payrolls report, diving into the numbers, we also noticed that there are less industries hiring people. Already, the tech industry, both in the US as well as in China, have been right-sizing their headcounts quite a fair bit, and that is expected to, spread in the US economy more and more. Sectors are probably going to be slowing down their hiring. Now, this is leading into our next hypothesis here. Before we get there, Sunny is going to be talking about this a little bit more, but the Fed is likely to increase interest rates by another 25 basis points in the upcoming meeting in early May. Now, energy prices has been a little bit volatile recently, as it's been going down since last year, when it hit a rather high number because of the war in Ukraine. But the problem is, of course, OPEC Plus has announced a 1 million barrel reduction in supply. That is on top of the previously announced cut in Russian supply, which is going to be extended. So net, I believe the total drop in oil supply is going to be 1.6 million barrels going forward. So obviously, when that was announced, the oil price spiked quite a fair bit. Now, based on scenario testing, Bloomberg has come up with a couple of projections as to how the higher oil prices may impact US CPI numbers, as well as global CPI numbers. So the baseline CPI is the white color line. So as you can see, heading into the end of the year, it should top off at about 4% if everything goes well. But if oil price, and we're talking about the WTI, goes up all the way to $113 per barrel, then what we might see is um, that the CPI numbers in the US might head up to about 5.5%, while the baseline remains at about 4. So as you can see, this is basically a plus 1.5% to headline CPI numbers in the US. Now, this is of course the extreme number, $113 per barrel. So he assumes that the world does not go into a globally synchronized recession. He assumes that the demand from China is going to be blown out of the sky, so on and so forth. But generally, that is not really the baseline number. So if you look at the more moderate number here, the WTI hovering at about $93 per barrel by the end of the year. And then the US CPI is going to be a little bit below 5%, or 4.9, 4.8, so on and so forth. Right, but that's it. Even a very mild WTI at $78, which is of course about the number right now. WTI is hovering around 80. Then you're going to have a little bit of a tailwind to the CPI numbers, slightly above the 4% by the end of the year. All right. So let's talk about stagflation. So this was the hypothetical scenario, which is what's happening to my slides, which is fast coming true. So there is a potential credit crunch in the US. What I mean is, as you can see in the last month or so, a string of banks have gone down a drain in the US, and they have mandated a bailout by the Fed as well as other banks. So there's a credit crunch simply because banks may not be so, or rather be more reluctant in issuing credit, loans to smaller companies simply because of the weakening balance sheet. Then you have got the additional problem of higher oil prices. Now, this is of course obviously going to feed into higher inflation and lower growth. So the US GDP for the full year 2023 is projected to grow 0.2%. That is a slowdown from the previous number of 0.4%. But that hides the growing realization that the second half of the US, in the US, there's going to be negative growth in Q3 and Q4. So this is based on Bloomberg research. As you can see, it's going to be underwater about 1% or slightly 1%. So this is going to be a technical recession in the second half, 2 quarters of negative growth. That's a recession. Plus, we have got elevated inflation far above the Fed's target rate of 2%. So that's inflation plus recession, therefore stagflation. Okay. Now, the lower GDP growth or the underwater GDP growth in the second half is driven by 2 main factors. So one is lower consumption, simply because US consumers have steadily been depleting their savings. So going forward, you can have lower consumption. Plus the deterioration in corporate profits. We've seen this since the 4th quarter results from last year, will obviously feed into a lower spending for capital expenditure as well as widening job losses. All right, so this is fast becoming the default. So yeah, so stagflation is real. Okay. All right, so I'm gonna leave it there and pass the time over to Sunny. Sunny?
Hey, can you hear me, Ben? I can't really hear you on your side.
Yep, I'm done.
Okay. Okay, so I think Ben went through the fundamental just now. Let's put some of the numbers that Ben went through earlier into some statistic numbers. So Ben went through the inflation numbers earlier, so I'll not be covering that. So basically, overall, the inflation rates come in slightly above better than expectation or better than consensus. The FOMC minutes also confirm what Ben mentioned just now, that they are expecting a recession this year, amount one. And then the retail sales number dropped by a whole 1% compared to the previous 0.2%. So that is a little bit of a worrying sign for the on the economic side. Okay. And then let's look at the Fed Watch tool for now. The Fed Watch tool calculating the probabilities of the Fed rate hike. So as you can see over here, we are comparing the current probability versus the 1 day before, 1 week before, and 1 month before. So these are the different bars of the different historical probabilities. So the latest reading we have is we are likely going to see a 25 basis point hike in May, on 3rd of May, bringing the range to 5 to 5.25%. And earlier, 1 week ago, it was only around 70%. So as we move towards the May announcement, the probability of a 25 basis point hike is likely to go higher. Okay, so I will not go through the economic data for this week, because there's not much of economic data for this week that's coming out that will drive the market. Most likely, it will be the earnings that will be driving where the market is going. So last week, we have started the earnings seasons as usual with the big banks in America. So as you can see, Citigroup, JP Morgan, Wells Fargo, all posted positive results on the EPS as well as on the revenue side. So that seems to signal that the banking system is still intact, so there's no systematic risk. And going forward into this week, we are also looking forward to more big companies announcing their earnings, including the other US bank as well as Tesla, Johnson & Johnson, and even Netflix. So let me cover the technical reading for this week. So let's start with the broad index, the Dow Jones Index here first. So for the past 1 week, it's up 1.39%. 1 month, it is up an impressive 6.7%, which is up from the low of March 2023. Year to date, it is only up, if you compare the start of the year, it's only up 2.23%. Now, the key levels to watch for the Dow Jones Index will definitely be this double top formation that you see over here in the first quarter of this year, between the January and Feb period at the level of 34,281. That is a double top formation. As you can see, last Friday close, we see a red candle because of this downtrend, a long-term downtrend line that we have. So once the index hit this level, it sort of pull back a little. But if you look at the MACD indicator as well as the RSI, MACD indicator is still positive, reading at 139.12. So there's a gap between the MACD line and the signal line, which means that there's still positive momentum in the share price or the index points right now. On the RSI side, the latest reading at 63.52 has not breached the 70-point overbought mark. So that means that there's still room for the index to go slightly higher. And if we go slightly higher, then we'll likely test this double top formation, which will be a very great test for the Dow Jones Index if it's going to break higher or it's going to be remain intact. So my gut feel is for now, at least I'm following what the indicators are telling me. If we are going to retest this double top formation at 34,200 with the RSI above the 70-point mark, signaling that it is overbought, we will likely see a retracement first or a reversal first to at least go back to the 20 days moving average, which is the Bollinger Band basis over here at 32,976. That before we can stage another test to this double top and possibly into a triple top formation. So for now, I think going forward, I think that the Dow Jones Index still have a bit of upside to move, but then the downside would sort of have a more risk or reward ratio if you're going into the Dow Jones Index. So I'll also not be surprised if there's any surprises coming from the earnings results that will push the Dow Jones Index down back to the March low that we see at 31,400 points level. So that is my take on the Dow Jones Index double top formation, a very bearish signal to watch out for in the next 2 weeks. Next, let's move to the S&P 500. S&P 500, for the past 1 week, it is similar to what the Dow Jones Index has performed. It's up 1.38%. For the past 1 month, it's up 6.73%. Year to date, it's also up an impressive 7.38%, as you can see over here. So the key level to watch for the S&P 500 definitely is the year-to-date high that we observed this year in February. That is the level of 4,195. And that's also have found confluence with the upper bound of the Bollinger Band at 4,193. So the low for this year, the support that will come in immediately will be the 3,810 with the Bollinger basis or the 20 days moving average at 4,043 points. So if you look at the indicator side, the MACD indicator reading at 10.47 is a positive reading above the zero baseline. Hence, it's still telling us that there is still positive momentum in the index movement right now. So not surprised if it will test the high of this year, the 4193, as well as test the upper bound of the Bollinger Band at 4195. On the RSI side, the reading at 62.58, maybe 7 or 8 points away from the overbought level of 70. So that means there's still a bit more upside. The momentum reading in the RSI is still strong and healthy. So we are likely going to retest year-to-date high at the level of 4195. Now there's two lines over here at the top side. You can see the other line that you see over here is, of course, the low that you see in last year, the early part of last year, somewhere in January. So that used to be a support level. May have a change in polarity into a resistance level if we come into that point as well. So a lot of critical levels coming on the resistance side, thereby resistance might be quite strong coming in for the S&P 500 if the earnings results are not that fantastic. Okay, so that's my take on the S&P 500. Next, let's move to the Nasdaq Composite Index. So Nasdaq Composite Index past 1 week is the best performer amongst the 3 US indices. It is up 1.54%. And then for the past 1 month since the low that we observed here in March, it is also up 7.737%. And year to date is up double digit 14.78%. So as you can see over here, the conclusion here or the results that we can draw from this is that the tech sector or the tech heavy index Nasdaq is still leading the growth or the upside of among the 3 indexes in US. So key levels to watch, of course, will be the year-to-date high in January over here. That is the level of 12,269 points. And then the low of this year happened in the middle of March at 11,035 points. So where are we heading now? We are heading to retest the high of this year at 12,269. Now the MACD reading is at 2.69. So a very little or a very small kind of a positive momentum now in the prices. As you can see over here, the MACD line, the signal line is also converging to cross or meet to each other. That means that it is likely the end of the uptrend that we are seeing right now. And if a crossover of the MACD line below the signal line were to happen, it signals to us that we are going to see a reversal or a downward reversal of the Nasdaq Composite Index. On the RSI side, the reading now at 58.51 says that it still have some uptrend positive momentum in the index points right now. So for Nasdaq Composite, it has been leading the gains up among the 3 US indices now. So I will not be also surprised if there is a reversal that's going to happen. Nasdaq will be the first one to go down, followed by the S&P 500, then the Dow Jones Index. So if the Nasdaq index were to go down, where will be the support level be? You will see that this double top formation in December last year will likely may have a change in polarity and become the first support for the Nasdaq Composite Index at 11,572. That is also the lower bound of the Bollinger Band that we see right now, also around the same level, 11,571. So this will provide the first level of support for the Nasdaq Composite Index. And this green line over here that you can see is also a uptrend line. Okay, when we connect the low in December as well as the low in March this year, will also provide further support below the 11,500 level. So around this level, 11,300, 400, you also have an uptrend line to provide support to the Nasdaq Composite Index. So below that, of course, we will go back to the year-to-date low, which is 11,035 points. So a few support levels for Nasdaq Composite to watch. So if it's going to come down, you can see that support level is coming in quite closely amongst this range of 11,500 to the 11,000 handle. So that's the 3 major US index. Let's move to the Asia side. Okay, so this is the Hang Seng Index. The Hang Seng Index is up 1.98% for the past 1 week. For the past 1 month since the low of March 2023 is up 5.69%. Year to date from here is up about 4.98%. So you can see Hang Seng Index has largely been trending inside the Bollinger Band. And the year-to-date high we observed was this level 22,400 or 22,700. That is the high that we saw in January of this year. And then you have that is also coinciding with the June high that we see last year. So connecting these 2 points, this might be a very long-term kind of double top formation, which is a very bearish kind of formation. On the support side, we can see that the low of this year in March at the level of 19,058 points. That is the main support level for the Hang Seng Index for now. Just above this, around here, around the 19,000 handle, you can also see that the May low and as well as the March low of last year also may come into play, thereby providing further support to the Hang Seng Index. So the 19,000 handle will likely be a very strong support for the Hang Seng Index if it's likely to come down. Okay, on the indicator side, the MACD indicator, the MACD line actually crossed above the signal line towards the end of March and thereby signal the uptrend that we are seeing now. So this uptrend, I think, is still pretty early. Last Friday or last week, we have just seen that the MACD line, the signal line, crossed above the zero baseline, and the reading now is at 83, around the 83-point region. So very likely to grow. There may be a chance that the momentum is continued to grow as because of the trend or the indication that the trajectory that the MACD line is moving, we may be able to see further upside. However, the momentum of this upside might be limited, as you can see that the gap between the MACD line and the signal line is not that great. Hence, the momentum is not very strong, but it's still positive and may still continue the uptrend according to the MACD indicator. On the RSI side, the latest reading at around the 56-point level, 6 points above the 50-point neutral mark, meaning that we also have a little bit of a uptrend positive momentum. So it will continue to go up, likely pointing to a further upside for Hang Seng Index, but then not a kind of an explosive jump in the prices. So definitely the upper bound of the Bollinger Band at 20,900 will become near-term resistance, and it will likely be trending in between the Bollinger Band, upper bound and lower bound as well. So Hang Seng Index positive on the longer term, however, upside might be coming in slowly, so we have to be patient on that. So next, let's move to the local index, the STI index. So we have also reached the April high for the STI index this month. Early part of this month, we see that prices actually touched the level of around 3,313 points, which is the high of April. For the past 1 week, it is most likely flat or slightly down 0.03%. For the past 1 month, since the low of March, we are up 3.96%. Year to date, comparing this point to the point that we see last Friday or this morning, is up about 1.9% or 2%. Okay, so the key level to watch for the Straits Times Index, of course, you can see during the December period here, which we covered a lot of times during the WMR. The December high here at 33,000 and around 3,306 point level, and the low of December 3,215 points level. This is the range that you see a lot of buyers and traders struggling with each other to see which one has the which one can gain the upper hand. So in early part of January, we managed to break through the 3,300 level to test the 3,400 level for the January high, but then after that we come back all the way down to see the January low at about 3,094 points or the 3,100 points. So I would believe that the Straits Times Index are likely going to be range bound again, tracking the December high and low. So around the 3,300 as well as the 3,200 points, that will be the range that the STI Index will likely be moving. Even if it were to break the 3,300 high, likely the next level of 3,350, which is the upper bound of the Bollinger Band, will also be capping the gains of the STI Index. On the MACD side, we have a 5.39 reading on the latest reading. So a positive reading above the zero baseline, meaning that there's still positive momentum. Hence, I believe the price were to go slightly use the 3,300 level as the pivot point to maybe go up to maximum of 3,350 points. After that, you will likely see the subsiding of that momentum in the MACD histogram continue, and thereby capping the upside for the STI. RSI at 60.37 also shows that there's healthy momentum for the uptrend to continue. But if it cross above the 70-point overbought mark, that means that we will also see a reversal happen. And if a reversal happen, of course, the 20 days moving average 3,260 points will come in, and then the December low of 3,225 points will provide further support to the STI level. So that is the overview of the major indices on the US, Asia, and Singapore side. Anything to add on, Benjamin?
No, I think that's it. Thank you very much for the analysis.
Okay, so with that, we will see you next week again in the same video. In the meantime, take care and trade safe.
Thank you very much. See you guys.